You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody, that music means it is time once again to dive back on into the world of advisors and asset managers and their intersection with the world of options. Yes, it is time once again for the Advisor's Option. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the network upon which all of you folks are hopefully having a good time, enjoying yourselves, getting some great content these days. If you're just listening to the Advisor's Option, you're missing out on nearly a dozen other programs here on the network. So make sure wherever you're getting this, and it is available on just about every platform under the sun, you do upgrade to the full network feed. That'll get you everything under the sun. A lot of other programs coming at you discussing volatility, futures options, crypto options, general options activity, options education, which I know is an important one for this audience, and much more. And speaking of more, if you want more in your lives, you have great questions. Like we just came off a little while ago, a great pro Q&A session with our good friend, Mr. Vixologist over there on Twitter, talking about all your questions on every volatility flavor under the sun. Those are available exclusively in our pro Q&A sessions. You can find out more about that, theoptionsinsider.com/pro. We also have options oddities there and a whole bunch more great giveaways, all sorts of fun, early access to a lot of great content like my interview sessions from down at the Options Industry Conference, and much more. theoptionsinsider.com/pro, the place to go to learn more. As we learn who's joining us on the old Advisor's Option program today. First, let's go out to the sunny shores. Yes, I said shores. Everyone forgets there is a shoreline of New Hampshire. It's very small, but it does exist. And there we will find our old friend, Mr. Matt Amberson, the principal over there at ORATS, a.k.a. Options Research and Technology Services, fresh from his tour around the globe via the Panama Canal. Mr. Matt, welcome back to the program. How was your tour of the canal, sir?
They broke the area between both continents. I can't believe that. We went and dug and it actually broke. So Panama was great, beautiful. People were great. It wasn't as hot as most people say. And, we're starting into summer here, the best time of the year here in New Hampshire on our little piece of heaven coastline. So it's all good, Mark.
I'm over under 10 Cuban cigars you had on your trip. How am I doing?
Yeah.
I'll take the over.
Yeah. You lost.
Oh, I lost. Wow. Oh, okay. Cracking down, I guess, over there on the Cuban cigar front. And also joining us this episode is a newcomer to the program and indeed to the network. He is Philip Sun, the co-founder and CEO of Adaptive. Philip, welcome to the Advisors Option program.
Thank you. Thank you, Mark, and thank you, Matt. Very good to meet your listeners. I should say that I am also on the shoreline. I'm calling in from Lexington, Massachusetts, and we probably have a little longer shoreline than New Hampshire.
a little bit longer shoreline in Massachusetts. You also have the Cape. That's kind of cheating, but you do have the Cape out there as well. So yes, a lot more. I'm from directly south of you. I was from Connecticut, so I'm familiar with all these various New England coastlines out there. But Philip, our listeners are not familiar with you or with Adaptive, so let's start there. Tell us a little bit about your background in the world of options and derivatives, as well as what it is you folks do over there at Adaptive.
Absolutely. Thank you for giving me the chance to meet your listeners. Well, let me just say up front, since this is a podcast and it's not a video show, I will confess right away that I am Chinese, not a native English speaker. So my English comes with a thick accent. So please feel free to stop me if I say anything that is unclear.
I never would have known, Philip, if you hadn't said anything. You would have slipped right under the radar.
Thank you. Thank you for that. Now, that being said, it's a segue to say that I have been in the United States since I was 17. And another confession, I'm now 53. So truly, I've been living the American dream. But that is for a different podcast. So as far as my professional background, currently I am a co-founder and CEO of Adaptive Investment Solutions, which is a Boston-based financial technology startup. We'll talk more about the features and capabilities of our technology platform. We aim to help advisors to put on downside protections for their portfolio, which probably is a very apt topic right now. But back to myself. Earlier in my career, I am I'm a quantitative investment professional, and I had played multiple roles as portfolio manager, trader, and researcher, primarily on the buy side with hedge funds and mutual funds, the likes of Highbridge, now part of JP Morgan, Fidelity, and Wellington, among others. I will also brag that I am somewhat of a hybrid of a practitioner and academic. I do have a PhD in physics from Carnegie Mellon University before I started my quant finance career. And now I also teach on the side finance and investments at business schools in the Boston area. And my favorite class is algorithmic and high-frequency trading in the Master of Science in Mathematical Finance program at Boston University.
All right, a lot of fun stuff to unpack, so let's get to it, listeners. It is time to kick things off with the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everyone, welcome to the P&L statement, the segment born of the pandemic. And it seemed like every episode during the pandemic, we spent a lot of time just saying, what the hell just happened? So many unprecedented things were happening on a weekly and indeed monthly schedule that we had no choice but to make it into its own segment these days. Let's go around the horn the way we started. Let's start out there on the shores of New Hampshire. Mr. Matt, a lot has been going on in the market since the last time you and I chatted and since you departed for the sunny shores of Panama. So catch us up, sir. Obviously, we have NVIDIA on the horizon. We have a lot going on. We had CPI last week. We have vol continuing to come in. Markets mostly rallying since the last time we chatted. What's catching your eye out there these days?
Yeah, all those things. I actually was interviewed about NVIDIA. And then one of the things I was talking about was that the implied move is about 8.3%, which is pretty high for a high dollar stock like NVIDIA. It averaged about 7.5 average absolute move over the last 12 quarters. But what's also very interesting is how bid up the calls are. So if you look at any stock, you'll see that the great majority of the time the puts have a higher implied volatility, the low strike puts, than the high strike calls. And in NVIDIA, ever since a year ago, ever since this AI culture has come on, NVIDIA has gotten a flat skew. So what that generally implies is that A, could be some bullishness, but B, that the multiple standard deviation moves are to the upside. So I thought that was interesting in NVIDIA. So they're coming up with their earnings, and there's a lot of froth around that. And then we also had a little bit of GameStop and the meme stocks come back. And as we're wont to do, we identify when that happens by looking at the small stock average skew of the out of the money calls versus kind of the out of the money puts, and see how that's been looking. And of course, it's when those meme stocks come back, the meme stocks are all very bid up on the skew or on the call skew. And now it kind of filters down into everything else. And so we're at a very high call skew again, not as high as the time, but that's how I measure how memey it is out there with this call skew. So it's up, and it went down a little bit, but it's still near its highs. And kind of what that looks like is same as in NVIDIA. The calls are about the same implied volatility as the puts. So that's what I'm seeing out there in a nutshell, Mark.
Memey, we have a new adjective for the market. What is the degree of meminess? Is it up there with the Sharpe ratio? You have your Sharpe, Sortino, and meminess now. Is that the new factor we have to quantify for the markets out there? Philip, same question for you, sir, as you're watching these mad markets unfold out there. Matt just alluded to, we had some, as he put it, meminess going off over the past couple of weeks. We, of course, everyone waiting for NVIDIA coming up in a couple of days. A lot of people have said it's NVIDIA's market. We're all just living in it. Of course, last week we had a cooler than anticipated inflation number that really seemed to boost assets across the board. So a lot of things to unpack. What is on your radar out there right now, Philip?
Well, Mark and Matt, I would say first that I have retired from making predictions about market directions or economy. That being said, I still have very strong opinions about them. I just won't share those opinions. However, I think what is relevant for us, especially for this podcast, is the macro backdrop for risk. I remember in 2008, 2007, when we embarked on quantitative easing, I was on the trading floor of Wellington. I had made this joke that the Fed had nailed the head of the snake to a cutting board, and therefore it destroyed volatility. This is, of course, what we observed, since the recovery from the great financial crisis. But now the Fed is on the opposite trajectory. They are raising interest rates, and as we can see, the reverse happens in terms of risk. So there's a lot of risk and uncertainty, even if they're not in the VIX numbers. They are out there. Risk will take very different shape and form. And I think this is the backdrop with the market euphoria. You call it a mad market, but maybe euphoria is madness. But with the market euphoria, the asset prices is very high. But on the horizon, we have a lot of uncertainty and risk that coming due, or the resolution of those will come due this year. For example, you mentioned inflation. I don't have any outlook on inflation, but I think I will rather take what the Fed's word at their face value. That is, they're also watching for the inflation to unfold. And part of this suggests to us that there's some uncertainty about the inflation outlook at this juncture in time. And from that, of course, the uncertainty about the Fed's monetary policy, whether they're going to raise the interest rate or cutting, how many they're going to cut. The robustness of earnings is also in question right now. And on top of that, we have some of these more kind of fashionable topics like what's the impact of AI revolution, as we've seen some of the manifestation in NVIDIA stock prices is a reflection on the macro bet on AI. And not to mention geopolitical risks. So my main concern is, this is actually an environment where it is truly important for us to have some downside protection for your investments, because for two reasons. The primary reason is there's a lot of risk that will be resolved in the next quarter or so. And as risk resolves, it will generate some immediate market turmoil. And then the second reason is the implied volatility is very low, which means the cost of downside protection is low as well. So it's a great time to put on some downside protection for your client portfolio.
Matt just mentioned the upside call skew we're seeing as a result of all this quote unquote meminess that is going on out there in the markets. Of course, when you're looking at downside, you're looking at the put wing. Are these skew levels, are these things that you watch out there at Adaptive? And if so, what are you seeing out there in terms of a broad market and broad index skew right now, Philip?
Yeah, the skew is also there in the index options area. I think for a long time, as Matt has mentioned, the skew is to the downside. The puts have higher implied vol than the calls. But just last couple of weeks, I've done some of the trades for my own portfolio. I noticed some of the index calls have lower implied vol than the puts. So at the minimum, it's flat, and in some cases, the skews are actually positive.
And Mr. Matt, you're talking about, of course, some of the individual names. One of the things we've been looking at for a while on the broad index front, and we're going to get more into this, I think, in a second in the Options 101, but is the relatively low level of implied volatility we're seeing priced into the puts. Traditionally, if folks are a little bit skittish about valuation levels, they'll start bidding up those puts. We're not seeing, depending where you're looking, even if you're looking out in some of the other indexes like the Russell, or you're looking at Qs, or looking at the S&P, doesn't seem like we're seeing a ton of juice baked into that put wing. Is that what you're seeing out there right now as well, Matt?
Yeah, if you look at the skew now, what's been very interesting to me is the effect of the zero DTEs, and what that is certain days are and I'll talk about the skew in a second, but certain days are much different than other days. For example, I have a position where I'm long the 22nd tomorrow and short the 23rd. And because there was this, like 3 or 4 points of NDX difference. So there's a lot more of that right now. That's totally catching my eye. And then, and as you say, the skew is a lot shallower. So we measure skew every 10 deltas, what percent that deeper call or put is than the one in the higher strike. And it's usually average about 6% difference in like the SPY or, the market-wide indexes. Now it's about 3%. So, and it gets as high as like 9%. And so it is, very flat. Still, when you go out, when you go out a few months, it does get steeper. Like December 26th, it's steep again. So I think the market is complacent. This rally, what is it, 5% up in the last month, has made people more complacent, but still in the very far out. Skew is still pretty pronounced, not as much as it used to be, but it's still out there. So definitely, Mark. What I would say is it's a lot flatter, especially for the short term, and then like people are really picking and choosing these days. I think a macro calendar is extremely important. We've come out with one in OVERATS. When is PPI coming out? When is Powell speaking? When is jobs? All these things are important because daily implied vol is moving around quite a bit. So that's what I'm seeing, Mark.
The day after Christmas. That's how long we have to wait to get skew back. I'm mad. It's December 26th.
No, 2026.
Oh, 2020. I thought they said December 26th. I was like, that's a very specific day. Either way, listeners, you have to wait a while for skew to come back, but you don't have to wait any longer for the Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101, the portion of the show where we explore an options concept in a little bit more depth, explain how you could utilize it in your clients' portfolios. And today we're talking about an interesting concept. We've talked in the past on the program about 60-40 and specifically the depth of the traditional 60-40 allocation. We've always said many times on this show, it's not sufficient in the modern market environment for advisors. You just say 60% equities, 40% fixed income. Bam, rinse and repeat. I'm done. I did my work. There's a lot more to it. You should be allocating to more things. Obviously, we talk about options here. At the end of the day, the only contractually guaranteed inverse correlation is a put option. So something to bear in mind. Look at years like 2022 when 60-40 went to die on both halves of the portfolio. So there are many different conversations we've had about 60-40 over the years on this program. I bring those up to segue into a conversation we haven't really had before on the show, which is the utility, or perhaps lack thereof, of another old term in the equity markets, which is buy and hold. You've heard people like Warren Buffett, of course, trumpet this for years. I'm sure many of you advisors out there are doing this on behalf of their clients right now. They're saying, find a investment that you like for the long term and stick with it and hold it for the long term in your portfolio. It's an intriguing concept. Obviously, we advocate for a little bit more of an active approach here on a program like that, which brings us to our conversation today. Philip, I know you and the team over there at Adaptive have coined a phrase you call buy and hold 2.0, which is taking a little bit different approach to this traditional market concept. Let's start. What do you mean by that? What is buy and hold 2.0, Philip?
Thank you, Mark. So the concept is very simple. We use downside protection, in other words, using put option overlay strategies to dial down the risk of a stock portfolio to the level of a traditional asset allocation portfolio. As you mentioned, for example, 60-40 portfolio, the risk equivalent buy and hold 2.0 portfolio is roughly, require you to own 100% stock with a downside protection that's roughly 10% out of money. That is 10% down out of money puts for 3 months expiration. Of course, if you change the expiration date, the percentages will be different. And why are they equivalent? Well, what we use a measure of downside risk, just simply looking at a downside semi-variance of a portfolio, and we compare the downside semi-variance of 60-40 portfolio to that of a stock portfolio with a put, and we target the downside semi-variance to the 60-40 in that portfolio. So that is buy and hold 2.0. And there are a couple of things I want to explain. They are not the same, right? Even though we call it risk equivalent, they are definitely not the same. And I would say that there's definitely a lot of value of traditional asset allocation portfolio. So if you ask me whether I think it's the death of 60/40 or not, I say that 60/40 is not dead. If you are an investor that needs income, having bonds in your portfolio make a lot of sense, especially in this environment when the rates are much higher, right? Now, if you are using asset allocation portfolio as a way to manage downside risk, then I would say the alternative that we propose here is much better. And the reason is very simple. While we are protecting the portfolio on the downside, and the portfolio is exposed to all of the upside. And over the long holding periods, the buy and hold alternative to any asset allocation portfolio, and we tested this under many different scenarios, will almost always outperform the asset allocation equivalent in total return terms, accounting for the cost of protection and, of course, crediting back on the payoff of the downside protection. Almost always. The couple of times when the scenario, when the strategy outperformed is when the market is in a downturn for a long stretch of time. So there's not a lot of volatility, but at the same time, the market is heading down. But even in that scenario, the buy and hold 2.0 is more superior to its alternative in terms of risk-adjusted return.
Now, Philip, our audience loves to get into the weeds a little bit. So you kind of mentioned this 3-month put that is 10% out of the money. Walk us through a little bit. How did you arrive at that construction? Because obviously we've had a lot of guests on this show and on the network over the years who've talked about a variety of different put allocations, 6 months out, 5% out of the money, put spreads, doing all kinds of other things. How did you arrive at this 3-month, 10% out of the money put, Philip?
Yeah, so that's just a rule of thumb. The 90% protection level is an average protection level over the last 5 years for a buy and hold 2.0. The way to arrive at this is pretty straightforward. We actually look at the volatility, the downside volatility, meaning the standard deviation of all the negative returns of the portfolio, and then we calculate the downside risk number. It's if a portfolio is without any protection, it will be roughly symmetric, right? Upside is roughly symmetric to the downside, give and take. And in those scenarios, the downside risk will be equal to the standard deviation of returns of the entire portfolio. But with options, with a put, we change. If I may borrow the term skew again, in this case, we skew the return to the upside. So the distribution is skewed toward the upside. So the downside semi-variance will now be much less if you have a put. Now, the downside semi-variance is a function of the protection level. So what happens is in our tool, we have this risk equivalent calculator to help you configure a downside protection for any equivalent asset allocation level. There, we will do the calculation to match the downside risk of the put plus the underlying equities to that 60/40 portfolio, right? So it could come out to be 90%. It could come out to be 92%. It ranges anywhere between 88 to 92%. So there's actually a range of outcomes depending on the market conditions, meaning what's the implied vol at that particular time. So that's how we calculate this. So in principle, it's pretty straightforward. We're looking at downside variance as a measuring stick to compare these two. In practice, it's somewhat tedious, and therefore, we try to automate this and deliver this as a service to our clients.
Now, are there any tweaks you make to that? A lot of times people will come in talking about protection, and the next question is, of course, how do I pay for that? So there's all sorts of approaches to that. Some folks like covered calls in addition to the puts, so they're effectively legging into the collars. Some like put spreads. Some like all of the above. Are there any income components to this buy and hold 2.0, Philip?
No, that's a very good question. Yes, indeed there is. We do support cover call writing, and there are features that we're developing that will target certain income level while minimizing the probability of being called away. So we can help you configure essentially a collar, right? But the downside protection is implemented in the index puts to target the downside risk of a 60-40 portfolio, for example. But the income component will be coming from the cover call writing on individual holdings in the portfolio, right? So it's a little bit of an arbitrage between the risk of individual names, which is not diversified, and the risk of the underlying portfolio. So in addition to the skew that we were talking about earlier, you also get a benefit of generating incomes on the individual names, which have a higher risk than the diversified portfolio, which will yield to a lower cost. So, for example, and this is not, this is kind of a somewhat contrived example because it may not be the way you want to construct this strategy. But let's say you have a Magnificent Seven portfolio. You want to hedge the downside at a 90%, so the protection level is at 90%. And you're willing to write a call at 110% strike, which means it's roughly a symmetric band around the current market value. You can generate at least 4 times as much income as the cost of the downside protection, right? Now, we don't recommend that as a strategy. Instead, what we are recommending is to use our tool to run the optimization to see what is the amount of income you can generate to match the cost of the downside protection, and at the same time minimize the probability of being called away.
So it sounds like the core focus of buy and hold is still that 10% out of the money, 3-month put. And then if the advisor is interested, if they're savvy enough, or they want a little bit of income to offset that, they could tweak it, Philip, with a variety of covered call options and things like that. Is that correct?
That is correct, and it will help the advisor to do that. And I want to explain also the downside protection. 90% is not our recommendation. 90% is roughly the equivalent downside protection level for a 60-40 equivalent. If you're interested in 80-20 equivalent or the reverse 40-60 equivalent, we also calculate the risk equivalent protection level for the advisor. The other thing I think that to explain is the 3-month protection is my personal favorite in terms of protection period. However, for a lot of long-term investors, maybe a longer-term protection level will also be appropriate, and it will generate less operational overhead to roll the contracts. And once you put on a protection, you can wait for 6 months, sleep for 6 months rather than do this every 3 months. But 3 months is my favorite expiration date.
Interesting. That's your sweet spot. I like it. I like it. Now, the other pushback we get from a lot of advisors, when they talk about hedging portfolios to their clients always say it's going to cost how much? Now, we did touch on at the top of the show, volatility levels and skew in that put wing is a little bit less than it traditionally is. So that could work in their favor. Not quite as expensive as it traditionally is. But that said, there is a cost to doing this, which is advisors and as a result, their clients have always pushed back on a little bit, especially in periods of just rampant bull markets. Why should I spend any money on insurance, Philip, when the market does not but go up? So what do you say to the advisors and more importantly, their clients when they inevitably get that kind of pushback?
Thank you, Mark, for that question. In fact, I just recalled one advisor we talked to and said, what you want me to spend money to lose money? That's stuck to my mind. So, our message to advisors and their clients are somewhat nuanced, but they should be straightforward. One is I would say first, now is a good time to consider putting on downside protection because of the reasons that we stated: low volatility, relatively flat skews, and the risk on the horizon. So you're getting more for your insurance contract than before. Now, that being said, I'm a proponent of a long-term, disciplined, regular downside protection. And in that framework, we do need to explain the cost component a little more. So there's two things that we will say. First of all, the cost in downside protection is not a throwaway cost. When we buy a put, yes, it will expire, but it's an asset. And it's an asset. And I believe the market, by and large, is generally pricing the asset correctly. And if you are a regular put buyers and you do it in a disciplined fashion, the potential payoff of any put contracts will largely offset the costs that you face today, right? So that's reason number one. So the cost that we see today in print is not the true cost of this strategy. The true cost of downside protection is much, much less. Secondly, the writing cover costs, it's tedious. It is an effective way to reduce upfront costs, though. And it is tedious because, currently on the market, when you want to write cover costs, the workflow for the advisor is you have to look up option chains on individual holdings, and then you have to figure out what is the appropriate strike price to write a call on, and you have to manage all of the operational issues that come with holding a cover call in your portfolio. Now, we try to make that a lot easier, more robust process for the advisors. On our platform, our tool will take a look at the portfolio, and we'll list all of the symbols all of the tickers that have enough share holdings so you can write calls on, and we'll pre-compute all of the available contracts, the number of contracts that you can write for each symbols, and we'll show you on one screen the premium income that you're going to generate from writing all of these calls. And this is huge. I'd like to brag a little bit about there's no technology out there on the market that will show the entire option chain information from 30 symbols at once. And we are able to list all of that information on one screen. And what that does is to help the advisors to write calls in a much more straightforward, robust manner. And this will make call writing, hopefully a lot easier to implement, and at the same time, it will become more effective in offsetting the cost of downside protection. Maybe even generate incomes.
All right, a lot to unpack there, Mr. Matt. I have a lot of questions for you as well. You're the king of the back test. You're always crunching away at various ways to protect portfolios and also how to pay for them. This subject of hedging is about as subjective as it gets in the options market. I'm sure if I ask a dozen different options traders how they view hedging with puts, I'd get a dozen different answers. Some wouldn't want to do it at all. It's too expensive. Some would prefer spreads, collars. Some would prefer a specific methodology and rolling that over time. There's a lot of different ways to carve up this onion. That said, let's start with this basic premise, Matt, of the 10% out of the money 3-month puts. What are your thoughts on that, its utility as a protective hedging instrument? And then if you were going to tweak it, how would you go about it, sir?
Yeah, so you're right. I mean, there's a lot to consider, and it's difficult to backtest because you only have 3 or 4 occurrences of things working to that level. So I actually think that you have to look at the market a little bit more and consider some other things rather than only backtest and only those types of things that have made you decide on a particular put or something. For example, I have an opinion. I think it's getting stronger and gaining more credence that the zero DTE, that is so important. One of the most important things that's happened in options over the past couple of years is actually making the market less risky by taking out the systematic positions that market makers used to have of very short out of the money put options and getting covered calls shoved down their throat. So that's why the skew, I think, is a lot less since we've seen zero DTEs. So I also think that there's less risk of a multiple standard deviation move to the downside because the market makers aren't exacerbating the move when it starts to happen. So in that light, I've been around for a long time, and I did well in 2008, did well in 2020, and you do. But I think the argument, just to help Philip out a little bit, is that you could be more invested if you have good protection, and you don't have to do things like buy substandard assets, if that makes sense, or non-correlated assets. I mean, some of these RMC meetings I go to, what the CBO puts on, they're buying some crazy stuff just to find something that's not correlated to the SPY. Well, if you're protected, then you could buy more of the equity since you don't have as much downside. So I think that's very valuable, because of the outsized returns that we've been seeing. So what I'm doing with my personal portfolio, and have been talking, quite a bit about over the last year on this program, is not just naked or long. I don't know how you say that, naked long, but doing a put calendar. So you still make money as it goes down to it, but it's not nearly as expensive. Even put diagonals are almost you're doing them for even, and as the front month corrodes or erodes, then you could buy those in and you have long way out of the money puts, that are there, because you always want something there. But I think you could also get a little bit more tactical, by having better signals. So you have to have something on, but you also, I think, you could have signals like buying when the ball starts going up. And it sounds counterintuitive, but, a lot of our back testing has shown that, and I've said it here many times, that markets don't get the implied volatility high enough and they don't get it low enough. And what that means is when the IB is going up and there's some market turmoil, they don't get it high enough, meaning that's actually sometimes a good time to buy. You wouldn't have had to buy for the last year, but you could buy it at expensive prices when it starts to get a little bit tumultuous. And alternatively, when it's low is a decent time to sell off, and at least that's shown almost all the time in our back test. So those are some things that I think about, and I've mentioned it on this show quite a time. So that's how I think about it, Mark.
It all comes back to zero DTE with you at the end of the day, Matt. You're the biggest proponent I know. I'm not the biggest, but one of the biggest out there. Fascinating stuff, listeners. What do you think? You think it is time to rethink the traditional approach to buy and hold? Do we need a buy and hold 2.0? We could spend easily the rest of the show debating this, but we have to keep on rolling. It is time for the earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the earnings volatility report.
Time flies when you're talking buy and hold 2.0, listeners. Let's get on into the topic of the day as well. For many of you are just sitting there right now as we're recording this, waiting for the big announcement coming out from NVIDIA tomorrow after the close. Many people are saying it's NVIDIA's market. We're all just living in it right now. And whither goes NVIDIA, that way goes the market out there. So a lot to unpack. So you could argue that earnings season, earnings reports, indeed earnings volatility, more important right now than perhaps it has ever been. And that's saying a lot because it was pretty important back in the .com and a variety of other periods out there. Not so important in the post-pandemic period, but we've covered that many times on the show. That said, Mr. Matt, when you're not talking to us, you're busy crunching all the numbers for the folks out there because you like them so much. Let's start. We are pretty far along in the season already. So what are you noticing out there in terms of trends and developments? And then B, what do you think is on the horizon for the big boys yet to come?
Yeah, as you mentioned, and you were very instrumental in getting us to do this, and we've gone over it quite a bit here, that when the market is a little lower in volatility, VIX, the earnings are more important. And especially now when there's more guidance being put out there, I predicted that this would be a good earnings for vol for movement. We measure actual versus implied, and we thought that the actual would be higher, and it has been 9% more if you owned every straddle of every earnings out there. And it's held, our weekly pattern is held, Mark. Typically the first week is low, second week medium, third week is where you start really getting the high payoff, in fourth week, and that's what we saw this year, or this quarter, I should say. 95% return, so 5% loser the first week, 111, so 11% winner second week, 14% winner third week, 7% winner fourth week, and then we almost always see it fall off after that, or it's more sporadic. But the average is 9% for holding. So, I think that's was a good call by us back before earnings started. And it has to do with the overall market, what's going on with it. And vol is coming in, so that usually makes the earnings more important. It's too early, I think, to call the July earnings, but we'll make the same type of assessment as it gets closer. As far as upcoming, definitely NVDA is a big one. We talked a little bit about that at the beginning of the show. It's trading 900 and mid 900s, $78 straddle, something like that. So just a huge move that they're guessing about. Out of the last 5 moves in NVIDIA, it was an outside move to the upside 3 of those times. So I'm not sure if you bet on that again or not, but that's what we've seen. So that's what I'm seeing, Mark, on the earnings front.
Well, Matt, we did use your data to construct our question of the week this week. We asked folks along those same lines with NVIDIA. They were pricing in about $78 at the beginning of the week when we ran these numbers. That's about $10 more than it's moved on average for its last few announcements. So, Matt, we asked our audience, do they think that's too cheap? $78 not enough? Is it too expensive? $78 too much? Is it Goldilocks? Is it just right? Or are they not touching NVIDIA with a 10-foot pole? Mr. Matt, where do you think they're lining up right now, sir?
I'm usually pretty good at predicting our audience, but this is a tougher one. I'm going to say pricey, though.
Right now, exactly 50%, Matt, say they want nothing to do with this.
Probably that's what I thought.
They are terrified of it, and rightfully so. It is an untamed beast. If you can't come to grips with it, you don't have that speculative capital to put onto that. It is certainly one to stay away from. Followed by, number 2, a distant number 2, I would say, pricey. They think $78 is too much, 26.7%. Number 3, too cheap, $78 not enough, 13.3%. And exactly 10% of you think it is the Goldilocks straddle. It is priced exactly right. Not too hot, not too cold. Philip, I'm curious for you over there at Adaptive. You mentioned before people are writing covered calls on individual holdings. So clearly individual names do play a part in what you do over there at Adaptive. And even if they don't, a big name like NVIDIA this week has reverberations throughout the market, not just in the name itself. So I'm curious for you and for your perspective and for your clients, how big of a driver of, let's say, hedging or income activity is earnings season? And if you have any thoughts on the season we just saw or what is yet to come, have at it, sir.
Thank you, Mark. I'll be honest that we do not track behaviors of our clients. We have very strict securities on client data, and unless they tell us on a support call, we will not know what they've done. So we don't have aggregated information about what our clients are doing. I will say, though, there's a lot of interest in owning high-octane names, as Matt has mentioned before, because these are good candidates to write cover calls on, especially if you think these names are kind of at a euphoria level. Writing cover calls, even if they got called away, it will be a good way to exit that particular position, with some pocket some call premiums, and at the same time realize some short-term gains. So from the risk management perspective, one thing I do want to kind of plug in, so to speak, is I think for investors who have very strong views about earnings and they want to bet on some earnings report, I would just caution that the psychological bias we have is we always are overconfident on our views and predictions, and they underestimate the risks that we are wrong. So that is to say that be bold in your bets, but at the same time put on some protection. So in case you are wrong, at least you're protected on the downside.
All right, listeners, we are coming up against it, but it is time to head on into the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everyone, it is time to get the buzz. We got a lot of buzz down at the OIC conference a few weeks ago, talking about a lot of topics, including this one, which is obviously very near and dear to the heart of an industry-oriented conference like that, which is, of course, the overall trend in options volume. Matt and I have been talking on this show for a while, certainly post-pandemic, about how that trajectory has been mostly up, sometimes shockingly up. Folks just can't get enough options. And that trend has continued pretty much unabated month after month, show after show, ever really since the pandemic kicked off in 2020, with the exception of a few months, including our last episode, actually, where we did talk about the downturn, the surprising downturn, roughly 10% year over year that we saw in March volume this year versus last year. Now, obviously, there were other factors involved in that, including the fact that March of 2023 was, of course, the contagion fear month. So volume exploded, VIX exploded, and we saw a lot of things going on there that really weren't consistent with a standard monthly March volume number. So we weren't exactly comparing apples to oranges. So maybe not surprising that March of 2024 was down roughly 10% from that already very lofty starting point. But that said, it did get some people thinking and some people worrying that maybe the bloom was off the rose. Maybe finally everyone who wanted to trade options was in the market and we wouldn't continue to see these explosive growth levels. Well, the numbers are now in for April, listeners, and I'm pleased to report that April was indeed a banger month by just about any definition. Overall volume up over a third, 34.4% from April of 2023. If you break it down by category, it gets even more impressive. Equity options, those were, of course, a bit of a low point last year. Overall volume growth was clearly up in the market, but most of that was driven by the growth in 0 DTE index options. If you took those out of the equation, equity options were actually kind of flat on the year. Well, that is not the case in April. Equity options were up nearly 28%, 27.7% year over year. ETF options up an explosive 40%, and index options up 44%. Yes, a whopping 44%. Now, there could be some different points of comparison there, number of trading days between 2023 and 2024. The devil is always in the details with these numbers at the end of the day, but still an impressive growth rate by just about any definition. Even the futures, even the VIX futures exploded up nearly 100%, 92.4%. All of that averaging back into 34.4% growth rate year over year. If you look at the total numbers, the year-to-date ADV, so the average daily volume in all those categories, we're up net about 6% year over year, 5.7%. So again, impressive growth rate across the board, no matter how you cut it. Certainly looking like that dip in March was more of a blip than a long-term trend. A lot to unpack. Let's go around the horn. We'll start with you, Matt. This is something you and I have been talking about for a while out there, which is, of course, can the gravy train continue? In March, people were worried. Were those fears allayed in April, or are you still skeptical of the long-term volume potential, sir?
Well, May is going to be anemic, I think. So at least in April, we had a pretty good little correction there, so that usually helps. So I think May is going to be less. But, I mean, these volume figures just keep chugging away. I mean, a lot more people are coming in due to education like this show and due to more people learning about options and more tech out there. I mean, the industry looks pretty healthy right now. So I have no reason to get in front of the bus, but I know that May is going to be a little less. So we'll see, Mark.
Well, Philip, the rising options volume tide certainly lifts all boats, including all of us here, directly or indirectly on this program. We all benefit from more people trading options rather than fewer. We haven't had a chance to talk with you before, so really quickly, what are your thoughts on this long-term growth trajectory we've seen in the options market, certainly post-pandemic? I have to believe that was a little bit of the catalyst for you launching an options-oriented business recently, trying to cash in on some of that growth. And then B, what are your thoughts on the hiccup we saw in March and the potential for future growth, Philip?
Yes, Mark. You're absolutely right. You got me. We were definitely banking or betting on the popularity of options, and I think it is very important that we have a very, very healthy options market, have a broad-based liquid market. We believe options ultimately is a very effective risk management tool, and it's an effective asset even for income generation and other purposes. But without a healthy and growing market, those value proposition will be challenged. Now, the March hiccup, it's probably, in my mind, I don't follow seasonal patterns in options volume market very much, but I have a sense that it's related to some of the macro environment that we were facing. Recall in the first quarter, there was a lot of uncertainties about what the Fed is going to do. I think by and large, most option traders are still using options for speculative reasons, less than for downside protection. So even though it was a period where people should be thinking about downside protection, but the reality is risk-seeking option traders will probably pare back their trades in that particular period. Personally, I think that's temporary. We already see that option volume has recovered and growing. And given some of the backdrop that we discussed earlier in the show, I do believe the long-term growth of the option market is very healthy.
All right, we are coming up against it, listeners, but I do want to squeeze at least one of you folks on in the time we have remaining. So let's head on into a real quick office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everyone, welcome to the office hours, the portion of the show where you folks take the reins with your questions, your comments. And I noticed this one. I couldn't let the show slip by without at least addressing this because it is very germane to our topic of the show, the nature of buy and hold and indeed hedging. This question comes from Andreas. He says, do the hosts of the advisor's option feel that now is a good time to purchase longer term, and he puts in parentheses, approximately 6-month protection for my clients with broad-based index portfolios? In particular, I'm thinking about SPY 2 to 5% out of the money puts, is it worth it to trade put spreads instead of just buying puts? So he's got about 3 parts to his question. Philip, as our guest, we'll start with you. I know this is a little bit outside of the range you were just talking about. This is longer term, 6 months as opposed to 3, and a little bit closer to the at the money, 2 to 5% as opposed to 10%. But what are your thoughts on Andreas's construction for his clients, and do you think now is a decent time for it?
Thank you, Mark, and thank you, Andreas, for this great question. And I would say you give me a chance to clarify my 3% bias, 3-month bias. I think the longer the duration operationally, the better, in the sense that you do not have to deal with the contract rolls. I do believe you need to, make sure the analytics of your downside protection matches your objective, because the longer the durations, the lower the delta for the same strike price. So you want to make sure that you're getting the adequate kind of hedge that you're looking for. And it just requires a little bit more analysis than shorter contracts. I will tell you the reason why I like shorter term contracts. One is, it limits the upfront cost. The 6 months contract is at least almost double. It's not linear, I know, but double the cost of a 3 months contract, right? So, but it also gives me the opportunity to dollar average into the price volatility of the options itself over time. Yes, at this point, the volatility is low. Therefore, it is a good time to lock in a low cost of hedging for longer term. So I would say go for it for the 6 months period. I'm sorry, Michael, was there a second part of the question that I need to address?
Oh, he just wanted to know about the percent out of the money, 2 to 5%, if you like that range. And also, do you like adding a put spread as opposed to just the put outright?
Sorry, now I remember. Yeah, so I would say 2 to 5% is right in the range of what I proposed, the 60-40 equivalent for a 6 months contract. So you're exactly right. So again, go for it. I think that's a great range of strike prices. Now, as far as put spread is concerned, I understand the objective of put spread. It reduces the downside risk. The cost of downside protection. Personally, I don't use put spreads, and the reason is very simple. One, when I do downside protection, especially in a more kind of disciplined but passive way, I don't want the model to be too complex. When you have put spreads, the analytics is a little more complex, and which means there's more model risk. This argument is a little academic, but that's a real risk that you get mismatched, strike levels that does not conform to your investment objective. And there's also higher risk that things may go wrong, since you're holding 2 contract positions. So personally, I don't use put spreads. If I were to reduce the cost of downside protection, if that's the objective, I rather write cover calls, especially in this environment. I think that's a more straightforward way to generate income to offset costs.
Mr. Matt, obviously this is very near and dear to you. The construction, I think 6 months, I'm not sure if that's your sweet spot out there. What do you have to say about 6 months, 2 to 5% out of the money, and the potential for put spread, sir?
Yeah, I do like longer term. I even go out a year on some of these. And like I said before, I'm not doing nearly as many just long. I'm doing more put calendars. And then, hoping to buy in the short or put diagonals buying in the short. So I have the units down below, but I don't, I have units, I have protection down there, but I don't think that this market is in such a spot where you should be 100% where you want to be protected in a downturn. I still think that you'd have a chance to watch your signals. Like I watch my signals like a hawk, and so I'm saving a lot of money that way on my protection mark.
All right, that music means we will have to leave it there for this month, listeners. But before we go, let's run around the horn. We'll start with you, Philip, as our guest. If folks are intrigued by anything we were talking about here on the show today and they want to learn more, where should they go? What should they do?
Yes, thank you, Mark. Yes, please. The easiest way to find us is on our corporate webpage. It's at adaptive-investments.com, adaptive-investments.com. And, come to see us. We are a growing company. We have a lot of new features, including optimization for call writing and fancy analytics like backtest and forward test that's either in place or being deployed really soon. So please do come. We have actually a free trial for our services. 30-day free trial, and you can trial us out with no cost.
There you go. Check them out. And Mr. Matt, if folks want to check out what you have cooking over there in the land of ORATs, where should they go? What should they do, sir?
Are you sitting down, Mark?
I am not. I'm standing up, but I could find a chair if I need it.
You may want to find a chair. We just found out that we have 181 million back tests in our back test finder while we were on the show. So
you hit it on the show. Yeah. I should go get a chair. Yes.
And then we have a trade ideas place where it only picks the back tests or the strategies that have worked well in this type of environment. So we break down the environment with the VIX, with the moving averages of the stock prices, with the RSI, with the implied percentile, and also the put call slope skew. And if we've back tested it well in this environment, we put it up on our trade ideas. So it's really cool. Very excited about that. Come on over to orats.com and check it out. We've had our biggest 2 months of growth ever since we started. So it's been a lot of fun, Mark.
There you go. Check them out over there at orats.com. So much going on. Happy to be a part of sending folks over there to experience ORATs and indeed Otto for themselves. That is going to do it for the advisors option today. Also going to do it for the network today. Back again tomorrow with a double dose. If you want more education, you should be checking out Options Bootcamp. We have a double episode tomorrow. Matt's been on that program in the past. We'll have to rope him into coming on again. All sorts of fun education going on there. Thursday, of course, this week in Futures Options, talking futures options, obviously, and the option block, talking unusual activity, all that memey goodness we were alluding to at the top of the show. Friday, of course, volatility views and indeed options oddities. If you want to check out all the network content, make sure you're upgraded to the full network. And if you want to go above and beyond, you want to get the pro Q&A sessions where we get into the weeds on lots of great topics like this, as well as, of course, options oddities every week. Only one place to go, theoptionsinsider.com/pro. Then we'll back again very soon with another episode of the Advisor's Option. Stay safe out there, everybody.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.